We're really looking at a recap of what happened in 2025 and a little bit of insights to what we think might actually happen in 26 and some things to look out for.
The most impactful statement of the year by the SEC chair, Project Crypto, quote, most crypto assets are not securities. And this is a groundbreaking statement.
The stablecoins market was primed for explosive growth. Now, Circle's market cap surged from $6.8 billion to $40 billion post Genius Act. And while USDC circulation and in the month of June hit $60 billion.
Then we see Circle completing its initial public offering before the Genius Act is even passed into law.
What a gamble. Talk about putting your bets down.
Essentially saying, banks, you can compete with the crypto exchanges and the crypto native companies.
Why the Genius Act? And why did it move way faster than anybody expected?
The Europeans have beat us to the punch in stablecoin regulation, and we, of course, did not like that one bit here in the US. So here are the top 10 things that you need to know about the Genius Act. And so these are some of the key guardrails. And if you want to learn more, check out our 8-page paper that explains the entire Genius Act in plain English.
Bitcoin's share of $2 trillion range. I can't believe I'm using the word trillion when we're talking about this stuff now. This year, like you said, it's been a whirlwind. There's been so much stuff that's going on. There's this snowball effect that started to happen at the beginning of the year.
Turning to the month of October, we have some really interesting news on NFT front, non-fungible token. And then in December, we have that could be groundbreaking, and this is from the CFTC.
And that's been a huge change, and I think we're going to see a lot of that happen in 2026 as well.
What's interesting is that it's actually also legitimizing the DeFi space.
One of the things that I feel was one of the major changes in this area were the banks, the regulators. Welcome to Fintech Confidential, bringing you the people, tech, and companies that change how you pay and get paid. You're building a fintech product. You want to offer digital assets, but wallets? That's the hard part. Security, compliance, key orchestration, blockchain integration. That's why fintechs, payment platforms, and custodians choose Defense. They provide wallets as a service that's API first, multi-chain by design, and secured with MPC. No single point of failure. So you can launch across over 50 blockchains, automate policy controls, and stay audit ready without managing private keys. Stripe's Bridge powers crypto payments through Defense. MoonPay scales wallets securely with Defense. Sphere grew without compromising on control or compliance. Even major FIs like Fidelity, ABN AMRO, as well as custodians like Zodia and Tungsten trust Defense to power their on-chain infrastructure. Developer ready, compliance approved, production grade from day one. If you're building in payments, exchanges, OTC desks, market makers, or DeFi, Defense wallets work the way you need them to. Request your demo at fintechconfidential.com/DFNS. Defense, secure wallets built right. Welcome to Web3 with FTC, powered by Fintech Confidential. If you're asking how blockchain and crypto fit into your business strategy, this is built for you. So let's go ahead and get started. I'm your host, Ted Huff, the CEO of fintech advisory firm Voalyre, and I'm here with my confidential informant, Musiala, a partner at Baker Hostetler, and he co-leads their Web3 practice along with the blog, The Blockchain Monitor. So this time we're sitting down, we're really looking at a recap of what happened in 2025 and a little bit of insights to what we think might actually happen in 26 and some things to look out for. One of the things that we noticed, there are two really big things that really got things rolling. And one was the Genius Act. The other one was the SEC Project Crypto. And really, this really kicked off a bunch of things. So I do want to kick this episode off really diving in and kind of doing a rollback and hitting on what happened in each month of the year. And Rob, I know you spent a lot of time looking at this stuff. What did January look like for us?
Well, this was a real pivotal year in digital assets, and it starts in the month of January. And in January, we saw SEC enforcement beginning to pull back and really signaling a real tone shift from the SEC. That started with a groundbreaking executive order on digital assets that was published, which really signaled what I would call the beginning of a new crypto-friendly regulatory environment here in the US. That was soon followed by the SEC beginning to drop enforcement actions, and over the course of the year, dropped every major crypto enforcement action, including dozens of cases and investigations against brand name crypto companies. And this signaled, by and large, the end of the era of what many people call SEC regulation by enforcement. And that was really over as of January, even beginning in January. The SEC also published SAB 122, which enabled more favorable accounting treatment for crypto custodians, which resulted in a ripe environment for the crypto IPOs and private capital raise events that occurred later in the year.
Well, in January also, I think it was really interesting to look at the crypto's total market cap really at the beginning of the year held near about 1.8 to $2 trillion range. Bitcoin ETFs, stablecoin volumes really continued to grow. But at the same time, Bitcoin's dominance really set as the primary institutional vehicle for digital assets.
In February, that's really when momentum behind the Genius Act first became real. The Genius Act was introduced into the Senate and House in the month of February. The House had its own version of a stablecoin bill. At the same time in that month, the SEC published a staff statement on meme coins, stating its position that meme coins that meet certain criteria are not securities.
Well, it's interesting because they identified that most meme coins meet the criteria. They're not really securities. That regulatory clarity really reshaped the meme coin landscape throughout the entire year of 2025. It was at a time where meme coin sector value hovered near the $100 billion mark. And the leaders like Dogecoin traded in the tens of billions of market cap with multi-billion-dollar daily volumes.
And then in March, we had more updates shifting away into new ground with the Office of the Comptroller of the Currency, the OCC, publishing Interpretive Letter 1183, which rescinded the requirement for OCC supervised institutions to receive a quote non-objection letter before engaging in crypto activities. In plain English, what does this mean? It means a bank doesn't need OCC permission to engage in crypto activities anymore. Additionally, in the same month, the SEC published a staff statement on proof of work mining, stating the SEC's view that proof of work mining activities do not involve the offer and sale of securities. So that's provided more comfort to the market around securities law, right, and regulation.
Well, during that same time, I mean, the markets really treated March as this institutional green light month. They listed the Bitcoiner miners outperformed BTC roughly by 10 to 15 percentage points on the month, while the total crypto market cap briefly reclaimed the $2 trillion mark. Again, BTC, Bitcoin, I mean, the share of that value was actually pushed back above the 55 to 58% range as investors really rotated more towards the institutional grade types of exposures. I'm wondering, Rob, how did that lead into what was going on in April?
Well, in April, we saw the Genius Act suddenly accelerating a lot faster than folks had initially expected, in part due to another SEC statement. The SEC published a statement on stablecoins, stating the SEC's view that certain dollar-backed stablecoins that meet certain criteria are not securities.
Not only that, but if you look at it, April really was the green light month for stablecoins, and we really saw stablecoin supply push towards the mid $260 to $270 billion range. On-chain stablecoin volumes ran nearly at $1 trillion for the month, and at least half a dozen U.S. public companies highlighted new digital asset treasury positions or ETF products on earnings and in their S1 filings of all places.
Right. And then in the month of May, we have more activity from the OCC. The OCC in May published Interpretive Letter 1184, which confirmed that national banks and federal savings associations, quote, may provide and outsource cryptocurrency custody and execution services, including buying and selling digital assets held in custody on a customer's behalf at the direction of the customer. In plain English, you can engage in crypto exchange activities just like any other crypto exchange. Additionally, in that same month, the SEC published a staff statement on protocol staking. This is
following on its proof of work statement. And in the protocol staking proof of stake network guidance, it confirmed that certain network activities related to proof of stake networks do not involve the offer and sale of securities. Again, giving further confidence to proof of stake network participants that they are not going to be in violation of the securities laws.
Like I mentioned, April got everything going with stablecoin, but in May, that activity shifted really from all the experimentation to true scale. The aggregate stablecoin market climbed to roughly $280 billion, up 37% from the $205 billion that it started at in January. The SEC's staking guidance really opened the door for Ethereum and Solana staking ETFs that really gave institutions a clean way to hold proof of stake assets and still earn 3 to 8% yields through regulated wrappers. I mean, that is just craziness. But June, it really saw some really interesting items happen as well. Circle had their IPO in June. They raised $1.1 billion, priced at about $31 a share. Then it surged 167% on the very first day of trading to $82.84, which really set to validate that the stablecoins market was primed for explosive growth. Now, Circle's market cap surged to a valuation from $6.8 billion to $40 billion post-Genius Act. And while USDC circulation continued to grow, and in the month of June hit $60 billion.
And it's fascinating to note that all this is occurring before Genius is even passed into law. Additionally, in the month of June, other stablecoin issuers announced new initiatives, including from the issuers of USD1, RLUSD, USDG, PYUSD, well as a new state-launched stablecoin by the state of Wyoming, WYST, and in addition to that, a new stablecoin launched by a major U.S. traditional payments company, FIUSD. You've got these more and more stablecoins being launched in the U.S. market, again, before Genius is even passed into law. Additionally, in that same month of June, the largest bank in France launched a U.S. dollar-backed stablecoin in Europe, and the largest U.S. bank launched calls a deposit token, which is effectively a stablecoin alternative, all again in the month of June before the Genius Act is even passed into law.
Man, that's crazy. Rob, like with all that going on in the first 6 months of the year, how did the second half of the year start off in July?
Well, it starts off with a bang because in July, the Genius Act, it passes both houses of Congress well before most people thought it would, and it's immediately signed into law and now becomes the law of the land, set to take effect about 18 months after it's signed into law. And so we get U.S. stablecoin issuers all of a sudden filing for OCC national bank charters, in large part because of some of the provisions in the Stablecoin Act. U.S. bank regulators published joint guidance for banks to engage in crypto asset safekeeping for their customers. And also in July, the SEC published guidance for crypto ETP applications, exchange traded product applications, to streamline the approval process for crypto ETFs. And at that point in time, apparently there were dozens and dozens of the applications in the pipeline waiting for the SEC's approval.
When we ran that episode for July, I think there were 70 total applications, somewhere around that number, that were sitting there in the backlog. But that didn't stop anything, right? So in July, Solana's new staking ETF decided to take off running and sprinted right past $300 million in assets on the back of additional 5 to 8% yields. And really what this did for me is it made me see that it was signaling that institutions have really started to get comfortable taking regulated risk on proof of staking. And across the board, we saw crypto ETF assets just continue to grow and grow month over month. And in July, they pushed well into the triple-digit $1 billion. And that isn't the only thing that grew. The supply crept towards the $300 billion mark in stable coins, showing that banks and fintechs, well, at the time, were quietly leaning in to the Genius framework rather than waiting on the sidelines to see what would happen. That really starts to show in some of the actions that started to happen after that. And Rob, what was the big things that you saw in the regulatory and legal side of the house for August?
In August, we have arguably the most impactful statement of the year by the SEC chair. SEC Chair Paul Atkins in August gave a speech announcing the SEC's Project Crypto. And in that speech, he stated that, quote, most crypto assets are not securities, end quote. And this is a groundbreaking statement. He also indicated that more favorable guidance for the crypto industry is forthcoming from the SEC. And also in that month, the SEC published another staff statement, this one on liquid staking, probably the most specific SEC statement of the year in the crypto space, where they confirm that certain activities related to the liquid staking market do not involve the offer and sale of securities. Again, giving an air of legitimacy, some comfort to the liquid staking industry that they are not going to be subject to an SEC enforcement action.
Well, I look at August as really being the release and the clearance of XRP that month. I mean, the Ripple case ended. A settlement conferred XRP is not a security, which you just talked about, that letter coming out. And then immediately after that, XRP jumped about 11% to $3.27 a coin. And the institutional volumes, they spiked nearly 208% to $12.4 billion. And really what this did was it briefly pushed it into the number 3 spot of market value. At the same time, Bitcoin's share of total crypto value hovered right around the 60% line, and the total market capitalization stayed in the low $2 trillion range. I can't believe I'm using the word trillion when we're talking about this stuff now. But that shows that blockbuster legal wins like this are now moving the specific assets more and more in the entire market. And really, that set up September for some really interesting announcements. Rob, what did you see for the regulatory side of the house?
Well, in September, from the stablecoin standpoint, we saw multiple businesses, not just from the crypto native side, but also from the traditional payments side, launch stablecoins and stablecoin related products and services. And then a securities law standpoint, in the month of September, the SEC published 2 no action letters. These are the first no action letters addressing the crypto markets that the SEC has published in quite a while. One of those no action letters addressed the token on a specific DPIN, decentralized public infrastructure network, and stated that that token would not be considered to be a security. And so again, this provides a measure of comfort for those working in the DPIN space that they will not be subject to an SEC enforcement action. Another SEC no action letter in the month of September addressed state trust companies and essentially gave assurance that if they meet certain criteria, state trust companies can custody crypto assets for customers in accordance with SEC regulations.
I mean, we keep coming back to the stables. I think this year was a huge place for stables. And in September, it started to feel and look like, at least for my conversations, as well as what was going on in the news, but stablecoin and staking products really started to look like core payment and finance tools, especially pegged to dollars. I mean, if you look at it, it was about $1.25 trillion in a single month, which roughly, if we look at the previous year, I mean, that's 87% year-on-year growth. And really, the throughput of this is way more than what we were expecting. And it really starts to put it in perspective of some of the largest, and this is like several times larger than the largest card networks and payment wallet providers. And the thing that's important also to know is that there were some streamlining listing standards that really started to get that backlog we were talking about with the staking ETFs on the assembly line and cutting approval times from about 240 days down to 60 to 75 days. And that just set off a rapid wave of ETF launches that followed.
Yeah, and this was definitely the year that the public markets embraced crypto ETFs, that's for sure. Turning to the month of October, we have some really interesting news on NFT front, non-fungible tokens, which we haven't talked about yet. And in the month of October, a U.S. federal district court found that the Bored Ape NFTs were not securities. This is a groundbreaking moment for the NFT industry, and again, provides more comfort that companies operating in the NFT space can launch products and launch NFTs without securities law violation concerns. Additionally, in the month of October, multiple crypto native firms all of a sudden filed for national trust bank charters with the Office of the Comptroller of the Currency, and those applications became the subject of a little bit of a debate.
Well, and it's funny because after the Bored Apes ruling, The NFT trading volumes just climbed yet again. It's so interesting to see how these rulings change the way people feel the risk level, because it climbed 30% month over month. From September to October, it grew by 30%. Now, give you an idea, that's $546 million and $10.1 million in sales. So even at the same time, Ethereum sat roughly at about 25%, to give you a perspective, from their 2025 all-time highs. And still, Bitcoin finished down quite a bit, roughly 20 to 35% below their 2025 highs, and still finished month down another 4 to 10%. Now, with Bitcoin, the dominance started to grind back a little bit towards about 60% on more than $3 billion of net inflows into spot exchange traded funds. But the one thing that I thought was really interesting also was the fact that the OCC National Bank Trust charters had started to roll out. And Rob, November, what happened to that announcement when we rolled into November?
As we mentioned on a prior podcast, the bank industry put up some resistance to these OCC letters. We'll dig more into that. But in November, just a couple weeks after the banks had mounted this resistance, the OCC finalized conditional national trust bank charters for all of the companies, all of the crypto native firms that had filed for those charters, including companies like Ripple, Circle, Paxos, and BitGo. Even though the industry groups had urged the OCC to block those charters, the OCC on one single day approved all those charters and issued a press release related to those approvals. And this really signaled to the crypto industry that we have an OCC that is here to support the digital asset space and that is not here to act as a moat or blockade in favor of the banks.
And as I look at November, if you look at the publicly listed custodians and exchange operators, I mean, they really outpaced the large main cap token index by roughly 6 to 9 percentage points on the month. While the spot funds pulled about $3.2 to $3.8 billion, it nudged Bitcoin's share of total market value back into the 58 to 60% band. It's kind of funny how it drops down into the 40s and then back up in the 50s and 60s. But I think one of the other cool things that happened in November also is the IRS and Treasury guidance under the revenue procedure 2025-31 really gave fund issuers a clear path to stake assets inside of exchange-traded products, and it's all done without blowing up the grantor trust tax treatment. Several sponsors started floating term sheets for products and passing through, as we've talked about multiple times already today, 3 to 8% on staking yields. That the shift may suggest that the proof of stake exposure, a plain price fund, is going to feel incomplete without it going forward.
And then in December, we have what I would believe is sort of an largely unnoticed update that could be groundbreaking. And this is from the CFTC. In December, the CFTC approved spot crypto trading for Binomial under the company's Designated Contract Market License, or DCM license, which is a CFTC regulated license. And this signals that the CFTC, which traditionally does not regulate spot products, may begin taking the lead in regulating spot crypto exchanges in the US. And if that were to be the case, that would really be groundbreaking, because it would be a new way for exchanges to gain the regulatory approvals they need to trade spot crypto in the US market. Additionally, the federal banking regulators issued their first proposed rule outlining a process for stablecoin issuers to submit applications under the Genius Act. And this is all going to lead up to what I believe will be a flood of Genius Act applications in 2026.
Well, and those applications are not going to slow down, because in December, SoFi also became the first nationally chartered bank to launch a stable coin, the SoFi USD, on a public chain, and has decided it's going to position itself as a stable coins as a service infrastructure for other institutions. At the same time, the largest video creator platform began offering its US creators payout options in PYUSD alongside of their fiat payouts. Now, what this tells me is that stablecoins have no longer stayed a side bet, this little thing that we try out a little bit. They are squarely sitting directly inside of each one of these organizations' revenue stack.
I agree. And with SoFi becoming the first bank to issue its own stablecoin, you better believe there'll be more banks looking to launch stablecoins or offer similar stablecoin infrastructure services in 2026. And what a whirlwind of a year for the digital asset space. Can't believe we just covered it all or attempted to cover it all in about 15 minutes.
And we left out so many things. It was so hard to pick the one, like the couple things to hit on each month, because this year, like you said, it's been a whirlwind. There's been so much stuff that's going on. But I think what it shows as we go through that is really there's the snowball effect that started to happen at the beginning of the year. And it just keeps growing and getting more momentum and getting all these different things. And the first real catalyst that was the enforcement pressure coming off. Then you have the regulators, the legislators throwing the anchor down, and that being the Genius Act to do that. I think it's been kind of crazy to see that move at that point.
Yeah, and I really agree with and like your analogy of the snowball effect. We can get into a little bit of the details and like how that operated specifically with Genius. I'm happy to talk to that if you like, Ted.
What would be really interesting is from your perspective, I mean, you cover the regulatory side of the house to a level that is second to none. Help us understand why the Genius Act mattered. And one of the things that I thought was really interesting is that how fast it happened. Why did it move way faster than anybody expected?
Yeah, it really did move faster than certainly faster than I anticipated. And looking back over the course of the year, you can sort of put the pieces together and see sort of how it happened. And it really begins, in my view, actually with late 2024 with the European MiCA legislation, which created a pathway for regulated stablecoins in the EU. And that, I think, by and large, a little bit of a sense of urgency for the US Congress and a little bit of a sense of FOMO for the US market, seeing that the Europeans have beat us to the punch in stablecoin regulation. And we, of course, did not like that one bit here in the US and wanted to make some moves to get ahead of that. That really drove a lot of what we saw at the beginning of 2025. That moved into very quick introduction of the Genius Act and the Payment Stablecoin Act, the two bills that were introduced into Congress in February 2025. But then we see the SEC issue its own statement on stablecoins in April, almost preempting the Genius Act and saying, well, from an SEC standpoint, this is how we're going to treat these stablecoins, in particular stablecoins that have their reserves examined monthly by U.S. public accounting firms, which are by and large the type of stablecoins that the market has accepted in the U.S. already. Then we see Circle, as we noted in the lightning round, completing its initial public offering before the Genius Act is even passed into law. So
what a gamble. I mean, talk about putting your bets down.
And what amazing timing, because, you know, they finished their IPO and just a couple weeks later, the Genius Act is in fact passed through both houses of Congress and signed into law. So they could not have made that timing any better. But what the IPO showed was that you have the flagship stablecoin company here in the US willing to take that risky step before we have an actual law passed. And then, of course, their bet paid off when the Genius Act is passed. And the Genius Act itself, from a legal geek perspective and financial services geek perspective, really does a great job of bringing stablecoins into the mainstream by enforcing a lot of this, frankly, a lot of the same safety and soundness concepts that provide confidence in the regular traditional US banking system and traditional US financial markets. Things like limiting the activity.
So before you dive into details, let's help everybody understand like the numbers behind what the Genius Act provisions are really regulating. I mean, if you look at, and I just want to give everybody like a sense of where this market has gone. Like the market cap for stablecoins grew from $2.5 billion in January of 2025 to $308 billion by December 2025. Now, mind you, that's a 50% increase in only 1 year. How often do we see that happening? Not only that, but the transaction volumes processed were $9 trillion. Now, mind you, that was adjusted for some bot activity. Those are real people actually using real transactions. And that's up 87% from the previous year. Now, if you compare this to traditional rails, the stablecoin volume now exceeds more than 1/4 of the credit card giants that we all know and love or loathe of their payments volume. The US Treasury holdings, the stablecoin issuers collectively hold $155 billion in US Treasuries, making them the 17th largest holder globally, up from 20th in 2024. What this does is it really positions stablecoins as a macroeconomic player in supporting the US dollar dominance. And the market concentration in this area really has been between two major players. Now, we talked about all these additional stablecoins that have been launched. There are going to be thousands of them out there, folks, but really Tether at $184 billion market cap and 69% of the market share. Then you've got USDC or Circle at $73.5 billion market cap with a 24.7% market share. And together, they control over 80 to 90% of the total stablecoin market, depending on what day you're looking at it, that is. What this does is Genius Bill, what it did is it created a $300 billion plus ecosystem processing trillions of dollars cross-border value that Congress has chose to legitimize and channel into the traditional financial guardrails, like what you were just talking about. So let's dive into the key act provisions of the Genius Act to kind of give an understanding of like the guardrails that have been put around so that this trillion and billion dollar industry doesn't go sideways.
Support provided by Skyflow. What if you could build fast but not break privacy? What if you could ensure data privacy, governance, and compliance with just a few API calls? What if you could worry less about PCI requirements while actually improving privacy and security? How much more time would your team have to truly innovate? How much faster could you build and ship new features? How much more powerful could your app be? Skyflow is a zero-trust data privacy vault delivered as an API. Skyflow's radically simple design lets you collect, secure, and tokenize personal information like card data and payment details. And with built-in features like encrypted data analysis and sharing, anonymization, and advanced governance, your days of choosing between data security and data usability are over. Whether you're just concerned with PCI compliance or need to go further to include CCPA, GDPR, SOC 2, and beyond, Skyflow has you covered. What if you could build fast but not break privacy? With Skyflow, you can. Visit skyflowsecure.com today to learn how.
So here are the top 10 things that you need to know about the Genius Act. Stablecoin issuer activity is limited to just issuing stablecoins. Stablecoin issuers are deemed to be financial institutions for purposes of the Bank Secrecy Act and anti-money laundering laws. Reserves in stablecoins must be kept in short-term T-bills and other liquid assets. Reserves cannot be pledged or rehypothecated. There will have to be procedures for timely redemption of stablecoins. Custodians of stablecoin reserves cannot commingle that money with other value and have to protect those reserves from creditors of the issuer. Issuers will have to have monthly reports examined by public accounting firms here in the US attesting to the stablecoin reserves backing the coins. Issuers with over 50 billion in outstanding stablecoins will have to have audited financial statements, just like any public company. And lastly, in the event of a bankruptcy, the first priority goes to the retail holder of the stablecoins, second priority to the stablecoin custodian, and third priority to the actual stablecoin issuer itself. And so these are some of the key guardrails. And if you want to learn more, check out our 8-page paper that explains the entire Genius Act in plain English.
That's a great paper you all wrote. I really enjoyed it when it first came out. It helped me understand it and changed my perspective a little bit on some of the areas that were a little fuzzy, for a lack of better things. But I want the audience to understand that like these requirements really are a direct response to a lot of the things that happened. I mean, an example was in May of 2022, Terra UST, it was an algorithmic stable coin and it lost its dollar peg. And then it's triggered this huge spiral and wasn't back where reserves. And the Luna token just imploded and caused everything to go basically down to not only zero, but negative. And I think that's one of the really interesting things with the Genius is one-to-one reserve backing, the timely redemption procedures you talked about, the custodian protections were all designed to ensure that no U.S. regulated stablecoin would repeat that same tragic failure. And there are so many different things that are in that. Rob said, go check out their 8-page report if you don't want to read the 150 plus document. Check it out. It'll definitely give you a good focus in on that. But it also ended up having a bit of an impact on DeFi, Rob. So help me understand what really happens in the DeFi world.
In my view, that passing the Genius Act, the US Congress is legitimizing the entire stablecoin industry. That's straightforward enough. But what's interesting is that it's actually also legitimizing the DeFi space, because stablecoins are the primary payment and store of value mechanism for DeFi protocols and for those operating and trading in the DeFi markets. And so by legitimizing stablecoins and creating a new category of what will soon be regulated stablecoins under the Genius Act on one hand versus all other stablecoins, now you have DeFi activity that, if Genius Act regulated stablecoins are underpinning that activity, all of a sudden that DeFi activity becomes a lot more legitimate and a lot more secure from a financial markets perspective.
Well, I think one of the most contentious parts of the Genius Act was the fact that there was the issuer interest prohibition and really put billions of dollars at stake for a lot of these providers. We're seeing some of the effects of that with the OCC charters and a number of different things. But because Circle was one of the first folks to come out and do the IPO and all this fun stuff, it really put like a microscope on how they were earning money and where it was going. And because they're so dependent on distribution through exchanges and other services, they're not able to benefit from this where they're getting a lot of their revenue. And I mean, think when I did the numbers, like in 2024, US Circle made like $1.6 billion in revenue just from investing its USDC reserves in short-term treasuries. But at the same time, I think what this is also doing is when you have the exchange is offering a reward. I forget we got to call it a reward. I want to call it interest. It's not interest. It's a reward. It's a yield on holding those items. I think it's really good now. And I've taken some benefit of that myself by moving some funds over there to reap those benefits of the higher rates of return on that. But one of the things that made me really think about this is that, we're talking about all this at a time when the rates are higher than what it has been. I mean, if you go back to just as late as 2021, we're talking 4-5 years ago. If we go back to that rate, I mean, that's nearly zero at an interest rate. This profitability piece of it really starts to collapse. And what happens to these rewards? I just thought it was really interesting that they said that the issuers can't provide any sort of yield, but the intermediaries and exchanges could.
Right. And I think that is absolutely going to be one of the most discussed topics related to the Genius Act in 2026. And as we've discussed on prior episodes, the banks have been fighting that concept, stating that these rewards paid through a third party are essentially the same thing as the issuer paying interest, and so should be prohibited, even though the exact language of Genius doesn't prohibit those types of reward. And so I think that's one of the biggest fights and will continue to be one of the biggest topics of discussion over the Genius Act in 2026.
Do you see regulators like issuing guidance or any sort of regulation to close this rewards loophole? Like how are they going to?
It's hard to say whether it's going to be closed or left open or narrowed or adjusted, but I do think that we will see regulations as the regulations are published to implement Genius. I do believe that those regulations will address this issue. And again, I think it's going to be the subject of a lot of public commentary from the banking sector, from the crypto native sector, and other sectors of the market.
So with that guidance, do you feel like that drove a new wave of stablecoin issuers and other crypto natives to really file for these OCC national charters? It's either 5 or 7, these handful of charters. Did it fuel that? And
I absolutely think it did. And I think this was another potentially unintended consequence, because as Genius is written, one of the ways to launch a permitted payment stablecoin issuer is as a subsidiary of a national bank. And I think the vision there, by and large, was probably that a stablecoin issuer would partner with a traditional bank to do this. Now, instead, what we have is the crypto native firms, some cases, the issuers themselves, filing for OCC bank charters, which indicates that they may be interested not only in playing the issuer role, but also in playing the role of the bank that has to sponsor that subsidiary under one of the methods for issuing stablecoins. Again, that just signals that the crypto native firms are not, while in a lot of cases are partnering with the banks, they are also looking to take market share from the banks and replace the bank's roles or perceived roles, what will be the permitted frameworks for issuing stablecoins under Genius.
Well, and that triggered, at least my opinion, if you look at that happening, it was kind of interesting if you look at the timelines, right? So you have the applications go in, then in October, Western Union makes their announcement, traditional payment provider, has all the MTLs, has all the money, like all the money licenses globally. So they offer theirs. And then you see a financial institution like SoFi and other traditional banks. I mean, they started either launching their own coin or they're partnering with exchanges, or it's just been crazy. And I really think that those trends are really going to continue into 2026. But I think what I want to cover just really quick is like there were 5 distinct issuer strategies that happened in 2025 because all stablecoins are not the same. The way to go to market with stablecoins are not the same. So we've talked about Circle and their launch. I mean, they really focused on the compliance as their competitive moat, with their strategy being an institutional first, maximum regulatory compliance. They decided to go IPO to become a public company. All of these things really to go, we are open to being regulated. We're open to being audited. We're open. And it really drove that in. As I mentioned, SoFi, they basically said, hey, if you can't beat them, join them. They built their own infrastructure. They're offering a stablecoins as a service for other banks and fintechs, which I think is going to be really interesting to see how community banks, do they partner with this or do they look for someone, a Ripple or a Circle, to play into that? Because a lot of the larger players in the financial services have said, hey, we're going to go with Circle because they've made so much traction. We're talking top 10 banks that have made that decision. Will the community banks do the same, or will they partner with another financial institution to bring that in? I think that's going to be another one. The other place that we're starting to see it, and Western Union was a perfectly good example of legacy providers deciding to pivot to stay relevant. Just give you an idea. I mean, Western Union's 175-year-old brand. They have over 400,000 retail outlets, 100 million customer base, and they're expecting to launch this the first half of this year. I thought it was really interesting, though, that they chose Solana as their base chain. So that was something that was really interesting for me, but it didn't do a whole lot for their valuation. I mean, their stock actually went down 10%. After making the announcement. And I think that was the interesting piece with a traditional payments player. You mentioned it, is that Wyoming, a US state, decided that they were going to launch a state-backed public innovation strategy first, focused on all of that. I mean, let's be honest. I mean, Wyoming has been digital asset friendly since day one. I'm not surprised they were the first state to do it. They definitely will not be the last, but I think it'll be really interesting to see how they scale and manage this with all of the caps that go on what they've been working through. It's really this use anywhere, public trust plus public benefit plus transparency. They're trying to lead it as this is how you beat the private profit maximization that's going on with players like Western Union, like SoFi, like Circle. And then you have these, I will call them multi-chain distribution plays, Ripple and the PyUSD. Both of those are going on multiple chains. It's really interesting because that's something that I've said over the course of a few years, is that those who can traverse across multiple chains without losing value, without losing any sort of momentum, are going to win. And I think that's going to be a place that we're going to continue to see grow. There's just so many things that are going in that cross-platform side of the house. So,
and I really like your perspective, Ted, on how this is not a one-size-fit-all market by no means, and that there will be different stable coins designed for different purposes, targeted at different people and entities, and using different business models. And it's anybody's guess as to which of these business models will ultimately succeed, which ones will coexist, and which ones will fail.
As we look at it, I started to dive deep into all the stable coins that have been launched this year. And by the way, there are over 100. So as we look at that, and I started diving into them, I started to notice there was this common thread of the buyer, the sender and the receiver had special needs, like special requirements, special pieces, especially when you got out of your big ones, your USDT, USAT, USDC. As soon as you got out of those, it really became community and or use case or customer base focused. A lot of folks are starting to look at this as a means of being able to move value anytime, anywhere, real time, no days off, just constant movement, so they can book their revenue and book their payables and receivables in near real time. And that's been a huge change. And I think we're going to see a lot of that happen in 2026 as well. But I think one of the things it's important also is we talked about all these different issuers. They're betting on a different future based upon where they sit today. Like I said, it's not a one size fits all. We're going to see more and more. I honestly think that in the next 5 to 10 years, we're going to see thousands and thousands of stable coins that are specific to their use. I mean, I could go on a whole bunch of different things. I want you to help me understand. I've looked at the SEC Project Crypto in plain English for non-regulatory and legal folks, what this signal to the market and what does it mean?
In very simple terms, the SEC has really, over the course of 2025, completed what really is a 180-degree pivot from its prior posture under the prior SEC chair and administration. It starts with this wave of SEC statement. As we talked about in the lightning round, beginning in February, the SEC began issuing statements almost on a monthly basis that were addressing very specific parts of the crypto market and essentially saying, if this part of the market meets XYZ criteria, we're not going to consider this activity to be covered by the securities laws. And they start doing this, first with meme coins, then with proof of work, then with stable coins, then proof of stake, liquid staking, and it goes on and on. And so it starts there. And then later in the year, as we mentioned, they issue actually 3 no action letters. We mentioned 2 of them in the lightning round, but 2 no action letters that were specifically addressing tokens in the DePIN market, decentralized public infrastructure. So again, having a very similar effect as the informal statements, but a no action letter is arguably even has a little bit more force of law, even though it's only related to its own specific fact set, but really giving the DePIN market more confidence that the SEC is not going to be regulating them with as heavy as a hand as it previously had. And then the no action letter essentially saying that a state chartered trust company can custody crypto for its clients. Then along the way, you've got the SEC, through a series of speeches by the SEC chair and a series of roundtables by SEC Commissioner Hester Peirce, launching what's called Project Crypto. And Project Crypto, really, in very simple terms, is the SEC laying out its roadmap for how it can not only end regulation by enforcement, but actually proactively supporting the crypto industry through proactive guidance and statements that provide clarity that the market has been asking for, all really culminating, at least in my view, in what I believe is the signature statement from the SEC chair in a speech in May when he said that, quote, despite what the SEC has said in the past, most crypto assets are not securities. And that is literally a 180-degree shift from prior statement by the prior SEC chair, who essentially said that most crypto assets are securities. With that moment and that speech and the Project Crypto speech, that's really when the 180-degree pivot, I think, was made complete. If that's not enough, then in November, just before the end of the year, we have another speech by the SEC chair where he lays out these 4 different categories of tokens and says that out of these 4 categories, only the 4th category is a security. I'll go over them really quick. The first one, digital commodities or network tokens. And these would be tokens that derive their value by operating a both functional and decentralized crypto system. Second category, digital collectibles. These are essentially things like NFTs and meme coins that represent rights to artwork, music, videos, in-game items, things of that nature. Third, digital tools, which are crypto assets that perform a practical function like a membership ticket, a credential, a title instrument, or a digital identity credential. And so those 3 categories, according to the SEC's chair's speech in November, would not be considered securities. And only the last category of, quote, tokenized securities, which a very simple definition, a financial instrument that is enumerated in the definition of a security and that is maintained on a crypto network in the form of a token. Only that 4th category would be considered securities. Now, mind you, None of this has the force of law yet. It does give quite a bit of confidence to the market, now has a clear framework for looking at this stuff that has been articulated by the SEC chair himself. However, none of it has legal effect. So it's just informal guidance or a statement as to the SEC's current posture. And so I think one of the challenges for the SEC in 2026, and one of the things I'll be keeping an eye on, is to what degree some of these concepts are actually brought into the law through proposed regulations, other formal guidance, or even through an act of Congress like the current pending market structure legislation. And I think that will be a key theme for 2026. What I would expect to see is proposed rules by the SEC, or at a minimum, additional guidance and informal statements by the SEC to further solidify some of this.
There's been so much regulatory stuff happening in 2025. I mean, there were some regulatory wins. I mean, Genius Act, Project Crypto, Solana XRP Clarity. A lot of these things didn't lift all the boats. They lifted those who had institutional backing, compliance infrastructure, and very, very clear use cases. I think one of the interesting things also was watching the ups and downs of the market also happen. One of the things that I feel was one of the major changes in this area were the banks, the regulators, they started playing by a new playbook. I think you mentioned there were 3 interpretive letters that they came out this year to really help people understand what was going on. They gave crypto asset safekeeping guidance. I mean, there's just so many different things that come along in that. And, I probably sound like a broken record at this point, but all this guidance really addresses the real vulnerability exposed in all of the different parts of the financial ecosystem. They're starting to see places that didn't work in the traditional, and they're making sure it doesn't happen in the digital asset side of the house. They're trying to figure out how to not have another SVB happen. How do we make sure that we don't have another FTX happen? How do we make sure that we don't, like, all of these swan events, but the definite dark spot on the industry have happened both on traditional as well as the digital asset side. And it's been really interesting to see how they're pushing through that. Maybe we can dive a little bit more into looking at the national charters. I think that's a neat area that we could dive into.
We can get into what I believe is a really interesting juxtaposition between the OCC interpretive letters and other banking guidance on one hand, and then this wave of OCC charter applications by crypto native firms on the other hand. One of the ways I analyze it is you have the 3 interpretive letters issued this year that you mentioned, Ted. The first basically saying you don't need permission. A bank doesn't need permission anymore, or non-objection anymore, to engage in crypto activities. The second saying that national banks and federal savings associations can provide or outsource crypto custody and execution services. Then the third, interpretive letter 1188, confirming that banks and federal savings associations can engage in what are called riskless principal transactions, where they are essentially acting as an intermediary, enabling 2 different parties to trade crypto assets. And then the crypto asset safekeeping guidance, which provides a supervisory framework for how a bank can custody crypto and what banking regulators will be looking for in their supervisory exams when they examine banks that take on this activity. You package all that together, and really what it's providing for the banking community, in my view, is essentially saying, banks, all the things that crypto exchanges have been doing for years now, you can do all that stuff under your bank charter. In other words, you can compete with the crypto exchanges and the crypto native companies. You can do all the things that they're doing, and you can and you should compete. Then you've got the OCC charters, where we've got a wave of crypto native companies seeking bank charters through the OCC. The banks fight this vigorously and they lose. And so what the message there is, in my view, is that the OCC is saying, no, sorry, banks, we hear your concerns. You don't think a national trust charter is the right charter for all these different activities that these crypto native firms are proposing to do. And yes, there are some safety and soundness concerns that we'll have to watch out for, but OCC believes it's manageable and under the purview of those national trust bank charters. All that to say that they're allowing the banks to compete with the crypto natives, and they're also going to allow the crypto natives to compete with the banks. And so they're allowing both parts of this market to attempt to compete with the other and steal market share or take market share from the other. Also, I might add, they're allowing both the sides of that market to cooperate or engage in coopetition, as some like to call it. And we did see the first huge example of that near the end of the year, where we had a major bank announcing that it's partnering with a major exchange to offer Bitcoin services to its banking clients. All this to say that the actions from the OCC and then the actions from the market in interacting with the OCC are really teeing up really intense competition and opportunities for collaboration between the traditional financial services space and the crypto space. And I think we're going to see a lot of that continue to heat up in 2026.
Rob, I want to dive into, like, we've talked about this. We've got 5 key takeaways for 2025. I'll let you start off. Like, what was number 1 for you in 2025?
So first key takeaway, the Genius Act. The Genius Act passing into law officially brings crypto into the mainstream.
Well, so for me, the next one would be stablecoins. They moved from just a topic to an actual product at mainstream scale. By the year end, I mean, we're processing $9 trillion a day in transactions. You're seeing creators start receiving payouts in stables. African users are accessing the dollar stability through platforms that are global as well.
That's a good one. And I'll give you a third, takeaway number 3. This was the year that U.S. capital markets embraced crypto. We had the public capital markets supporting the sector through crypto company IPOs, as well as over 143 crypto ETFs, along with SEC approval for in-kind redemption and staking, and public companies launching digital asset treasuries.
Not to be outdone, I mean, really the competition between digital asset, crypto, and traditional financial institutions, I mean, it went insane this year. The OCC, federal banking regulators, they provided guidance and really set the stage for all of these companies to compete with banking services and traditional banks to compete with crypto and digital asset services. I mean, these guys are going all over the place. Like we mentioned, there's already been a handful of charters in 2025. I'm guessing we're going to see in 2026 a handful more come out, at least in the first half of the year. And Rob, to close us out, what is the number 5 item for the key things for 2025?
There's so many, but if I had to pick one, it's the SEC completing its 180-degree pivot and really shifting away from enforcement by regulation and opening up an entirely new posture with statements, guidance, speeches, really creating a crypto-friendly environment from the SEC's standpoint that seems to be set to continue in 2026.
And it's funny you mention that, because one of the conversations that I had at the end of last year was 2025 was how, as these regulators were going out and talking about all these changes and what was going on, they have publicly stated, I would rather give loose guidelines that allow me to have some sort of oversight and some sort of insights into what's going on versus leave it completely open until it's perfect and then it be too late. And I'm summarizing obviously the conversations, but that is something I thought was really interesting. And you brought up like what you see happening in 2026. Like from my perspective, 2026, and like kind of give you a preview. Like this is my thought. Let's give a preview of kind of what to expect in 2026. From my perspective, the speed of change, the speed of regulations, the speed of more players, speed of acquisitions, like the speed of everything around this space is going to continue to accelerate. The thing that I'm wondering is, are the wheels going to come off, or are we going to finally get to a good cruising speed? So hopefully it's a good cruising speed and not the wheels come off. What is one of the larger picture perspectives that, Rob, that you're looking at for 2026?
My message to the banks and the traditional financial services sector, payments companies, things of that nature, is find a crypto industry partner. Yes, there's going to be a lot of competition, but I think there's even more opportunity for collaborative partnerships across sectors. And I think that because of all the momentum we've seen in 2025 and the continued momentum, and I agree with you 100%, Ted, is just going to increase in 2026, the market is going to demand the ability to access traditional and crypto services in a seamless way from the same source and manage their traditional financial assets alongside their crypto assets and vice versa. And I think some of the larger players may try to offer termed the super app, where All that's offered under one platform, managed and owned by one company. But I think more often, the way to bring those products to market more quickly is through collaborative partnerships where you've got 2 or 3 different actors that have each built their own stack. It's a lot easier to integrate those already built stacks through APIs than it is for one partner to build 2 more stacks from the ground up and then and make that integration. And so from a tech perspective, I encourage both sides of the industry, the crypto natives and the traditional financial services firms, to ask themselves, what's a good partner for me? How do I launch a new product through a tech integration and a partnership agreement instead of building from the ground up? So in terms of what I would expect people to see happen in 2026, I think we're going to see more collaborations, joint ventures, mergers and acquisitions across the traditional crypto native and traditional financial services space. What will be driving those events will be the desire to bring new products to market that enable the ultimate user of those services to access both traditional financial services and crypto-powered services all in the same application. And so I do think we will see a wave of joint venture agreements, collaborative partnerships, mergers and acquisitions across the crypto and traditional financial services space.
Well, Rob, there's no way we could have covered everything today. We don't have enough time. We don't have it's not possible. But I do appreciate you spending the entire 2025 with us over here at Web3 with FTC. I'm looking forward to diving deeper into the regulatory and legal perspective with you going into 2026. And thanks again for hopping on and covering what 2025 had and what we might be able to think about for 26.
Thanks, Ted. It's been a pleasure being on the show this year, and I look forward to more podcasts in 2026. It'll be an exciting year.
Well, folks, if this discussion about Web3 got your attention today, that is fantastic. There's a lot more where this came from. Go ahead and head over to YouTube, Spotify, Apple Podcasts, or wherever you listen and hit that follow button. And if you want to stay plugged into everything we're doing and everything we're tracking over here, go to fintechconfidential.com and sign up. That's where all the deep dives live, as well as future episodes. You'll be able to learn more, and be sure to share this with someone who's serious about where fintech is going. And as always, keep moving forward. As we wrap up today's episode, I've got one last thing for you. If you're in the trenches fighting fraud and financial crime, you know it's a complex battlefield. That's where Hawk's AI tools for real-time payment screening, AML, transaction monitoring, and dynamic customer risk rating come into play. These aren't just buzzwords, they're game changers designed to make your compliance more effective and less of a headache. Imagine slashing through false positives with precision and giving your compliance strategy the edge it needs. Head on over to gethawkai.com to sign up for a demo and discover how their platform can revolutionize how you fight fraud and financial crime.
This has been a production of DD3 Media, with all rights reserved. This is provided for informational purposes only. It is not offered or intended to be used as legal, tax, investment, financial, or other advice. We strive to provide accurate and up-to-date information, but will not be responsible for any missing facts or inaccurate information. You comply and understand that you should use any of this information at your own risk. Cryptocurrencies are highly volatile financial assets, so research and make your own financial decisions.